there, accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. This video will cover Chapter 1, Introduction to Accounting and Business from Corporate Financial Accountant, 16th edition. So in this chapter, we learn a bit more about accounting, which is often referred to as the language of business, and we start to discuss what a business is, how it operates, and the role that accounting plays. So some of the chapter objectives for Chapter 1 includes describing the nature of businesses and the role of accounting and ethics in business, describing generally accepted accounting principles, including the underlying assumptions and principles, stating the accounting equation and defining each element of the equation, describing and illustrating how business transactions can be recorded in terms of the resulting change in the elements of the accounting equation, describing the financial statements of a corporation and explain how they interrelate, describing and illustrating the use of the ratio of liabilities to stockholders' equity in evaluating a company's financial condition. So as it relates to the nature and business of accounting, a business is an organization in which basic resources, which are referred to as inputs, such as materials and labor, are assembled and processed to provide goods or services, which are referred to as outputs for the customers. So the objective of most businesses, obviously, is to earn a profit. So the profit is the difference between the amounts received from customers for goods or services, which is often referred to as revenue, and the amounts paid for the inputs used to provide the goods or services, which is referred to as expenses. So as we go through this chapter, it focuses on businesses that operate to earn a profit. However, many of the same concepts and principles, they apply to not-for-profit organizations such as hospitals, churches, government agencies, etc. So when anyone embarks on the endeavor to start a business, there are three types of businesses that operate for profit. This includes a service business, a retail business, and a manufacturing business. So service businesses, pretty straightforward. They provide services rather than products to customers. So an accounting firm, a nail salon, right? These are service-based businesses. They provide services versus a retail company. A great example of retail companies would be like Target or BJ's or Forever 21. Retail is also referred to as a merchandising business. So what it simply means is that they purchase items and then they resell it to customers. So next we have manufacturing businesses. And these businesses, they essentially change basic inputs into products that are sold to customers. So let's say if we go to Target, Target might sell an office desk. Target did not make the office desk. They purchased the office desk from a manufacturing company. And this company took the raw materials. They took the wood, they had nails, paint, they essentially assembled it and put it together. So when you think of a manufacturing company, think of a business that essentially takes the raw materials and puts it together to have that finished product. So another great example would be Ford or GMC, you know, one of these companies that essentially make vehicles, or Boeing, they manufacture airplanes. So these are the three different types of businesses: service, retail, and manufacturing. As it relates to the activities of a business, the businesses engage in the following three types of activities. So we have financing activities, operating activities, and we have what's called investing activities. So operating activities are essentially those by which the company generates revenue from their customers. Investing activities, on the other hand, these are activities by which the company acquires their long-term assets for use in their operating activities. Then we have our financing activities, and these essentially include any activities by which the company obtains funds to start and to operate the company. So once these business owners, they decide, okay, well, I want to have a service business, or maybe I want a retail business or a manufacturing business, they now need to ensure that there is a proper way to account for all of the transactions that take place on a day-to-day basis. If it's a small company, maybe there's about 10 to 20 transactions per day. But think about these really large Fortune 500 companies where there's 10,000, 20,000, maybe even millions of transactions that take place per day. So that is why we have what's called accounting. So accounting can be defined as an information system that provide reports to users about the economic activities and conditions of a business. So accounting is often referred to as the language of business. So much like if we read a book using words, but in accounting, we tell a story, we understand what is going on by using numbers. So here we have an exhibit. Accounting as an information system. So first things first, we need to identify, well, who are the users? That's the first step. Secondly, we essentially assess the needs of the users. Third, we design an accounting system to fit what we need to do or present to the users. Four, we record the economic data. And five, we prepare the necessary accounting reports. So we have two branches of accounting, right? It can be used internally by the company, and this includes management and employees. And then the financial statements, the records can be used externally, and this includes investors, creditors, customers, and the government. So as it relates to managerial accounting, as mentioned, it's internally used by managers and employees, and these users are essentially directly involved in managing and operating the business. So the objective of managerial accounting is basically to provide relevant and timely information for managers and employees in order to make certain decisions. As it relates to financial accounting, as mentioned, this is where the financial information is used externally. And the objective of financial accounting is to provide relevant and timely information for the decision-making needs of outside users of the business. So for example, let's just say that a business wants to obtain a loan. They would need to provide their financial statements, their income statement, balance sheet, statement of cash flows, etc. They would need to provide that information to the lender. The lender will review it, and based on the information they review, they will make a determination on whether or not they would lend the money to the business. So the objective of accounting, as we pointed out, is to provide relevant and timely information for decision-making. So with that being said, accountants must behave in an ethical manner so that the information they provide users with can be considered trustworthy and useful for making decisions. So ethics are defined as moral principles that guide the conduct of individuals. Unfortunately, business managers and accountants sometimes behave in unethical manners. So we'll see in a few slides that there have been some companies that have engaged in unethical accounting practices, and unfortunately has cost millions of dollars. So some unethical things that take place: failure of individual character. Ethical managers and accountants are honest and fair. However, sometimes managers and accountants, they often face pressure from supervisors to meet company and investor expectations. Sometimes there's a culture of greed and ethical indifference. So by their behavior and attitude, senior managers set the company culture. So that's something referred to as setting the tone at the top. So if those at the employee level, they essentially see that management is taking advantage, maybe they are robbing the clock, or maybe they are, not taking care of what's happening within the company, the employees, they might mimic and follow suit. Versus if management, they can see that they are strict, they are stringent, they care about the company and what happens, they are ensuring that things are represented correctly, and the employees in such case, they would also follow suit. So here we have some examples of accounting and business frauds. We have about 5 companies we'll review. The first is Countrywide. A really big one was Enron Company. So the nature of the accounting business fraud for Countrywide, they misled investors, and as a result, the CEO had to pay $22.5 million and was permanently banned from serving as an officer or director of a public company, Enron. They fraudulently inflated their financial results, and it resulted in bankruptcy. Senior executives were criminally convicted and sent to jail, and more than $60 billion billion in stock market losses. Next, we have Goldman Sachs. They misstated and omitted some key facts from investors. So obviously that had an impact on the decision of the investors. The result was the company agreed to pay $550 million as a fine, and they reformed some of their business practices. Wells Fargo, they improperly opened customer accounts without their permission. The CEO was fined $17.5 million and was banned from the banking industry for life. Lastly, we have Xerox Corporation. They recognized $3 billion in sales prior to when it should have been reported, and they had a $10 million fine to the SEC, and 6 executives were forced to pay $22 million. So as a result of these accounting and business frauds, keep in mind, this is just a few. We just discussed 5, but there are several frauds that take place. Here we see the frauds on a very greater scale, but there are some smaller frauds that take place within smaller companies. So as a result, Congress passed laws to essentially monitor the behavior of accounting and business firms. So we have what's called the Sarbanes-Oxley Act, it's often referred to as SOX, S-O-X, and it was passed in 2022. So SOX established a new oversight body for the accounting profession called the Public Company Accounting Oversight Board, often referred to as the PCAOB. And in addition, SOX established standards for independence, corporate responsibility, and disclosure. So certain companies are required, especially public companies, are required to have internal controls in place. So as it relates to accountants, there's numerous career opportunities that are available to students who decide that they want to major in accounting. So the demand for accountants at the moment is very great, right? There's lots of businesses are starting every day. So an individual can decide that they want a career track in private accounting. And in private accounting, these are accountants employed by companies, governments, and not-for-profit entities. Some career options include being a bookkeeper, payroll clerk, a general accountant, budget analyst, cost accountant, internal auditor, information technology auditor, and the salaries range. Some certifications are available. There's a certified payroll professional, certified management accountant, certified internal auditor, and a certified information systems auditor. And these are just a few certifications. There are more out there that are available. And next we have public accounting. And these are accountants employed individually or within a public accounting firm in audit and tax services. And the certification that is needed is a certified public accountant, a CPA designation. So next we start to move on to the generally accepted accounting principles. So we just pointed out that there needs to be ethics. And there's SOX. SOX essentially established the PCAOB, and then there also needs to be rules. So we have what's called generally accepted accounting principles. So financial information in the US is based on these principles, generally accepted accounting principles, often referred to as GAAP. And GAAP is a collection of accounting standards, principles, and assumptions that defines how financial information is going to be reported. So here we have accounting standards, and these are the rules that determine the accounting for individual business transactions. And we have accounting principles and assumptions that provide the framework upon which accounting standards are constructed. So within the United States, there's the FASB, which stands for the Financial Accounting Standards Board, and they have the primary responsibility for developing accounting standards. The FASB maintains an electronic database that's called the Accounting Standards Codification. It's often referred to as ASC, and it contains all the accounting standards that make up GAAP. And anytime there's changes in the FASB codification, they're made using the Accounting Standards Update. Next, we have what's called the Securities and Exchange Commission. So this is an agency of the US government that has authority over the accounting and financial disclosures for companies whose shares of ownership, which is stock, are traded and sold to the public. And outside of the United States, most companies, they use accounting standards and principles that are adopted by the International Accounting Standards Board. So the IASB, they issue the International Financial Reporting Standards, which is referred to as IFRS, and it's essentially the equivalent of GAAP, Generally Accepted Principles. But just keep in mind that there are some differences between FASB and IASB accounting principles. Next, we have some characteristics of financial information. So as we pointed out, we discussed with financial accounting and managerial accounting, it's providing relevant information for making decisions. So the primary goal, it needs to be useful. So to be useful, financial reports must possess two important characteristics. The first is relevance, and there must be faithful representation. So relevant information has the potential to impact decision-making, whether it's internally or externally. And faithful representation means that the information accurately reflects an entity's economic activity or condition. So relevant and faithful representation are enhanced by the following. We have what's called comparability, and this includes consistent reporting that allows users to identify similarities and differences among reported items. We have verifiability, and this allows users to agree on the meaning of reported items. We have timeliness, and this requires distribution of financial reports in time to influence a user's decision. And we have understandability. This requires clear and concise financial reports that facilitate user interpretation and analysis. So financial accounting and generally accepted accounting principles, GAAP, are based upon the following assumptions. We have what's called the monetary unit, time period, business entity, and going concern. So the monetary unit assumption, this requires that financial reports be expressed in a single monetary unit or currency. So the monetary unit that's normally determined by a country in which they operate. So for example, in the United States, the US dollar is the monetary unit. Next, we have the time period assumption, and this allows a company to report its economic activities on a regular basis for a specific period of time. In doing so, the financial condition and changes in the company are reported periodically and on a consistent basis. So in the US, reports are normally required on a yearly basis, and oftentimes they're what's called quarterly reports. So here we see there's what's called a fiscal year and what's called a natural business year. So generally, there's a calendar year, and this is from January 1st to December 31st. And then we have what's called a fiscal year. So a fiscal year is any other 12-month period. So think of a fiscal year from birthday to birthday. With each birthday that passes, you are now a year older. So next, for the third bullet point, the business entity assumption. This assumption limits the economic data in financial reports to that directly related to the activities of the business. For example, right? If an accountant has a business, they would not record their personal activities, their personal property, or the personal debt of the owner. So this essentially ensures that the economic data in the financial reports are those directly related to the activity of the business. Next, we have the going concern assumption, and this requires that the financial reports are prepared, assuming that the entity will continue operating in the future. And this assumption justifies reporting items such as equipment, buildings, and land at their initial or historical cost rather than liquidation or the forced sales value. Next, we have some various forms of businesses. So once an individual decides, hey, you know what, I want to start a business, I want to have maybe a service business, a retail or a manufacturing business, or maybe a hybrid of the two. From there, as we pointed out, all businesses are going to engage in 3 business activities: financing, investing, and operating. And now they need to determine, well, what is going to be the structure of the business? So we essentially are going to look at 4 of the main business forms. So the first is a proprietorship. This is essentially, if an individual wakes up one morning and they decide, hey, I want to start a business, they're in business. With a sole proprietorship, 70% of business entities in the United States are sole proprietorships. There's ease of entry. There is nothing that needs to be filed with the state. As mentioned, you can just start a business one day. But one of the challenges with the sole proprietorship is that there is unlimited liability. And what that simply means, here we see A and B painting. Let's just say A and B gets a contract job to repaint a home. And unfortunately, the paint that was used, one of the individuals that lived in the household, they were allergic to the paint, and God forbid they passed away. In such case, let's say A and B is a new business and there's not a lot of net income left over. Unfortunately, because this business is structured as a sole proprietorship, if the business has nothing to cover the medical costs, the funeral costs for this individual, they can come after the owner personally. So they can take the owner's personal assets, such as their car, their home, they can attack their bank account, etc. So that is one of the challenges of setting up a proprietorship. Same thing for a partnership. A partnership, you can decide to just wake up one morning and start a partnership. But here we have Jones and Smith Architects, and let's just say that they have a contract to put together a building plan, and a key thing was missing from this building plan, and the structure fell. Unfortunately, let's say it was Smith. Smith put together the architectural plan, and unfortunately, again, it's a new business, or maybe it's an existing business, but there's not enough funds to cover the lawsuit. They come after the business doesn't have enough. They come after Smith, and Smith doesn't have enough. In a partnership, they can now come after Jones and take what he has personally. So as it relates to partnerships make up 10% of business organizations in the US. And then in the next slide, we'll learn about what's called LLCs. The next we have what's called a corporation, and a corporation is organized under a state or federal statutes, and it is a totally separate legal tax entity. So our corporations, they make up about 20% of business organizations in the US. Some examples are Alphabet Inc., Apple, Ford Motor Company. And with corporations, they essentially, their ownership is not one or two individuals, it's various individuals. You can purchase stock in the company, so any of us can essentially be an owner of a corporation. Obviously, depending on how much stock we own, that ultimately determines our ownership percentage, but we're owners nonetheless. Next, we have what's called this limited liability company, and this combines the attributes of a partnership and a corporation. So for that sole proprietorship and that partnership, they can do what is called set up a LLC. For a sole proprietor, they can set up a single member LLC, and for a partnership, they can set up a multi-member LLC. And what that simply means is that in the event that, let's just say for A and B Painting, he was set up as an LLC as opposed to a sole proprietorship, they can't come after him personally. The same thing for Jones and Smith Architects. It stops at the business level. However, there is something called piercing the corporate veil. So in the event that the business owners, they are not treating the business as a separate entity, and let's say they're going out to eat using the company card, they are purchasing personal items for their home, personal items for themselves, then they are not treating the entity as separate. So therefore, in such case, there might be what's called piercing the corporate veil, and they can come after the assets of the members, even though they are an LLC. So in addition to the characteristics that we mentioned earlier, the assumptions, there's 4 principles that are integral to financial accounting. So we have what's called the measurement, historical cost, revenue recognition, and expense recognition. So the measurement principle, this ultimately determines the amount that is going to be recorded and reported. Next, we have, if there's transactions between 2 independent parties, then this is called an arm's length transaction. And then it provides amounts that are both objective and verifiable. And anytime we're recording an item at its initial transaction price, that is called the historical cost principle or the cost principle. Revenue, as we mentioned a little earlier, that's the amount that's earned from providing services or selling goods to customers. And the revenue recognition principle determines when revenue is recorded in the accounting records. Next, we have expenses. They often say in order to make money, you have to spend money. So expenses are the amounts used to generate revenue. And the expense recognition principle, sometimes called the matching principle, requires that expenses are recorded in the same period as the related revenue. So the accounting equation is essentially the fundamental. So if someone is building a home, the foundation is the most important thing for the structure. And as you are learning about accounting, this equation is the foundation. So the following equation shows the relationship among assets, liabilities, and equity. So this equation is referred to as the accounting equation. And as it relates to our assets, assets are essentially any resources that are owned by the business. So anything that the business owns that would provide a future value. So if we have cash, cash can be used to purchase things, pay for expenses. If we have equipment that we use in our business, if we are dealing with a retail business, our inventory, when we sell it, provides us with a future value. Equipment, anything essentially that has a future value is an example of an asset. Liabilities, on the other hand, are essentially obligations and debts that need to be taken care of by the company. So liabilities represent who we owe. Next, we have equity, and our equity consists of 4 components. We essentially have what's called investments by the owners, and this is referred to as common stock. So this is essentially an infusion of cash into the business to run its operations because the owners are investing cash into the business. The second way in which stockholders' equity increases is when the business earns money. Whether the business earns money by providing a service or selling a product or both, revenue represents an increase in stockholders' equity because the business is earning revenue. Next, we have what's called dividends, and this is when money is leaving the business and it is being distributed to the shareholders. So money is leaving the business and it is being given to the shareholders in the form of dividends. This has a decreasing effect on our stockholders' equity. And then lastly, we have expenses, and this is essentially any time money is leaving the business to assist with generating revenue. So for our stockholders' equity, we have 4 components: common stock, dividends, revenue, and expenses. So for each transaction that takes place, it has an impact on the financial statement. So let's think of it this way. Let's say the company received the phone bill from Verizon, right? They received the bill for, let's say, $111. Because they paid the bill, the company now has less cash on hand. So this is an example of an economic event or condition that directly changes an entity's financial condition or results of the operations. Therefore, this is considered a business transaction. So all business transactions can be stated in terms of changes in the elements of the accounting equation. So we'll start to look at some examples. So here we have transaction A. And it states on November 1st, 2023, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange of common stock of the corporation. So the corporation issued common stock to investors, and it's basically, as we mentioned earlier, provides proof of their ownership rights. So in this case, Chris Clark, he infused $25,000 into the business, and by doing so, he now has ownership rights in this corporation. So therefore, there's an increase in cash in the amount of $25,000. And therefore, the common stock, which represents the investment by owners, increases by $25,000. So one key thing to keep in mind is that as we look at the accounting equation, assets equals liabilities plus stockholders' equity, it must be in balance. Our total assets of $25,000 equal our stockholders' equity of $25,000. We have no liability, so therefore our liability is 0. So we have transaction B. It states November 5th, 2003, Net Solutions paid $20,000 for the purchase of land as a future building site. The one key thing is that any time we see paid, that means that cash decreases. And the cash decreases because we paid something. So in such case, we see they now have land worth $20,000 and cash is worth $5,000. So we'll scale back. We started off with $25,000 in cash and we spent $20,000. So we see that the total value of our assets remain the same. We still have $25,000 worth of assets. It's just that the makeup of the assets change. Initially, we had $25,000 cash. Now we have $5,000 in cash and $20,000 worth of land. And our balance, our equation rather, remains in balance, 25,000 in assets and 25,000 of shareholders' equity. For transaction C, on November 10th, 20 year 3, Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the near future. This type of transaction is called a purchase on account and is often described as follows. So anytime we purchase something on account, we essentially have an obligation to pay it at a later date. So in this case, we see that the liability created a purchase on account. So we have what's called an accounts payable. It's basically an IOU. We are letting the company know that we are going to pay them at a later date. So anytime we have items such as supplies that are going to be used in a business in the future, they are referred to as prepaid expenses, and these are essentially assets. So for transaction C, this is the impact. So we started off with cash of $25,000, then we purchased land of $20,000, and then now in this case, we have supplies of $1,350. So the total value of our assets increased by $1,350. And now here we see initially all of the funds that were spent for the land was consisting of the investment by Chris Clark. However, now we have our first liability. We owe a company $1,350 because we did not pay for the supplies of $1,350. Now here for transaction D, on November 18th, 2000 year 3, Net Solutions received cash of $7,500 for providing services to customers. So we received cash, we have money. So here we see that there's an increase to our cash account of $7,500. And anytime money is coming into the business, it's for one of three reasons. Either we borrowed the money, so there's a liability. Either the investors invested money into the business, so there's an increase in common stock, or the business earned the money in the form of revenue. So in this case, as we see here, we earned the money. And as we mentioned earlier, revenue is a part of stockholders' equity. So therefore, we have an increase of cash of $7,500 and an increase in our revenue of $7,500. So as illustrated for Net Solutions, revenue from providing services is recorded as fees earned. And revenue from the sale of merchandise for, let's say, a retail company like Forever 21 or Walmart, it's recorded as sales. So some other examples of revenue include rent revenue, interest revenue. So instead of receiving cash at the time a service is provided or goods are sold, a business might decide that, hey, I'll accept the payment at a later date. So we have what's called an accounts receivable, and accounts receivable is essentially monies that the company is expecting to receive in the future because they provided a service or sold a good to a customer and the customer promises to pay in the future. Next, we have transaction E, and it says November 30th, 20 year 3, Net Solutions paid the following expenses during the month: wages of $2,125, rent of $800, utilities of $450, and miscellaneous expenses of $275. And during the month, Net Solutions spent cash or used up other assets in order to earn revenue, because as mentioned, if you have a business, in order to make money, you have to spend money. So assets that are used up are referred to as expenses, and some expenses include supplies that are used any payments for employee wages, utilities, and other services. So here we see the effect of expenses is the opposite of revenue. Obviously, if money is coming into the business, it has an increasing effect. But when money is leaving the business, it has a decreasing effect. So in such case, we see our wages, our rent, our utilities, and our miscellaneous expense. Each of these have a negative effect. And then the total amount of cash that we've paid also has a decreasing effect. Next, we have transaction F, and it states November 30th, 20 year 3, Net Solutions paid creditors on account $950. So keep in mind, when we first purchased our supplies, we purchased them on account. It means that we received the supplies and we did not make a payment. So we have a liability and obligation to pay the vendor. So in this case, we're paying the vendor $950 of how much we owe them. So therefore, we see anytime paid, we know that cash is leaving the business and our liability is decreasing by $950. So therefore, paying an expense reduces stockholders' equity as illustrated in transaction E, which we saw earlier. And paying an amount on account reduces the amount that is owed on the liability. Initially, we owed $1,350, and now we only owe $400. For transaction G, November 30th, 20 year 3, Chris Clark determined that the cost of supplies on hand at the end of the month was $550. So the cost of supplies on hand represents those that are not yet used, and at the end of the month represents $550. So now we have to think. We started off with $1,350 worth of supplies, and now at the end we only have $550. So think of it like your bank account. You started off the day with $1,350, you went shopping, and now you only have $550 left. That means that you've used up $800. So therefore, we need to decrease the balance in our supplies account by $800 so we can show the correct ending balance, which is $550. And we need to record the value of the supplies that have been used up. So we would record it as supplies expense for $800. Next, we have transaction H, and it states November 30th, 20 year 3, they paid dividends of $2,000. So dividends are essentially distributions of earnings to the stockholders, and the stockholders are the owners. So the payment of dividends decreases cash, and it has a decreasing effect to stockholders' equity. So much like expenses, dividends are recorded in a separate column to the right of common stock as a negative amount. So the effect of the payment of dividends of $2,000 is as follows. So again, once we know that we are paying cash, there's going to be a decrease to cash. And in this case, we see paying dividends also has a negative impact on our stockholders' equity. So this is basically a summary of all of the transactions for Net Solutions. So we have all of the transactions that affect the cash account, the supplies account, our land account, which are our assets. We have one liability account, which is our accounts payable. And then we have our stockholders' equity. We have common stock, which represents the investments by owners, our dividends, which represents distributions of earnings to owners, or AKA stockholders. Then we have our revenue account, fees earned, and then we have our various expense accounts. And then at the end, we see our total assets of $26,450 equals our liabilities plus the total of our stockholders' equity. So here we see the effect of transactions on our stockholders' equity. And as we pointed out, there's some key things to keep in mind. So for our stockholders' equity, it's reflected based on our common stock. And then we have our retained earnings. So our retained earnings is the stockholders' equity account that's created from business operations through revenue and expense transactions. So our revenues have an increasing impact to our retained earnings. and dividends, which are distributions of earnings to shareholders, stockholders, and expenses, they both have a decreasing effect to our retained earnings. So after we record all of these transactions, we essentially need to summarize them. We need to be able to clearly see, well, okay, how much cash did we spend overall? What is our ending balance? How much did we spend for supplies expense, et cetera? So we look at accounting on a very small scale, but again, some companies might have as much as millions of transactions per day. So therefore, after all of the transactions have been recorded and summarized, we prepare reports for our users. So the accounting reports provided this information are called financial statements. So the primary financial statements of a corporation are the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows. So for our income statement, it's essentially a summary of the revenue and expenses for a specific period of time. Maybe it's for a month, a quarter, which represents 3 months or a year. We have the statement of stockholders' equity, and this is a summary of changes in stockholders' equity that have occurred during a specific period of time. And again, it might be for a month, a quarter, or a year. Next, we have balance sheet. And the balance sheet is a list of assets, liabilities, and stockholders' equity as of a specific date. So this is usually at the close of the last day of a month or a year. So the balance sheet is tracked from the inception of the company versus the income statement and the stockholders' equity, which is for a specific period of time. Next, we have the statement of cash flows, and this is a summary of the cash receipts and cash payments for a specific period of time. So here we have an example of the income statement, and there's a specific order in which these statements need to be prepared. And the reason being is because there's an interrelationship between all of the financial statements. So all financial statements, they're identified by the name of the business, the title of the statement, and the date or period of time. So here we start off with Net Solutions. We have the income statement for the month ended November 30, 20 year 3. And we get our net income. We started off with the fees earned. We subtract all of our expenses and we get net income of $3,050. Now from there, we recognize we need to set up our statement of stockholders' equity. We see our common stock. We had common stock issued of $25,000 that Chris Clark invested into the business. And then for our retained earnings, we started off with a zero balance. It was a brand new business. And then from there, we had net income of $3,050, which had an increasing effect. But then we also paid out dividends of $2,000. So therefore, our retained earning balance is $1,050. So we start off with the common stock of $25,000, $3,050 of net income, which had an increase in effect, minus the dividends paid out. The new ending balance for our statement of stockholders' equity is $26,050. So from there, we prepare our balance sheet. And we see that the amounts that are reported on the balance sheet or on the statement of stockholders' equity are transferred to the balance sheet. So we see our common stock shows $25,000, and then our retained earnings shows $1,050, and these amounts were calculated by the statement of stockholders' equity. And then lastly, we look at our statement of cash flows, and we see that the amount $5,900, which is our ending cash balance, is also reflected on our statement of cash flows. So the key thing to keep in mind is that all of our financial statements, they are interrelated, integrated. They have an impact on each other. So the income statement, as we pointed out, it reports the revenues and expenses for a period of time, and it's based on the revenue and expense recognition principles that we mentioned earlier. And these principles match the revenues and their related expenses, so they are reported in the same period. The excess of revenue over expenses is called net income, net profit, or earnings. So simply stated, if we earn more than we spend, we have net income, net profit, or earnings. Or If the expenses exceed revenue, then there is a net loss. So if we spend more than we earn, there is a net loss. Next, we have the statement of stockholders' equity. And this report essentially reports the changes in stockholders' equity for a period of time. It's prepared after the income statement because the net income or net loss for the period is reported in the retained earnings column. And it's prepared before the balance sheet because the amount of common stock and retained earnings at the end of the period is reported on the balance sheet. Next, for the balance sheet reports the amounts of assets, liabilities, and stockholders' equity in a vertical format. And this form of balance sheet is commonly used and is called the report form. Next, we have the statement of cash flows. And as discussed earlier, businesses engage in three types of activities. We have operating activities, and this reports the summary of cash receipts and cash payments from operations. And the net cash flow from operating activities normally differs from the amount of net income for the period. Next, we have our investing activities, and these report the cash transactions for the acquisition and sale of relatively permanent assets. And then lastly, we have financing activities, and these report the cash transactions related to cash investments by the stockholders, borrowings, and dividends. So this kind of just goes over some of the integrated relationship, the interrelationship between the financial statements. So as we pointed out earlier, and we saw both the depiction, income statement, and stockholders' equity, the net income or net loss is then in turn reported on the statement of stockholders' equity. And for our statement of stockholders' equity and balance sheet, the ending balances for our common stock and retained earnings is transferred and reported on the balance sheet. And then for our balance sheet, the amount of cash, the ending balance for our cash is reported on our statement of cash flows. So this is also just another, connecting link. The balance sheet, essentially is linked to our statement of cash flows, this $5,900, also reported on the statement of cash flows. Our income statement has an impact on the statement of stockholders' equity. So when the retained earnings balance is now transferred to the balance sheet, the net income and the dividends that are paid have an impact on the ending balance of the retained earnings. So the balance sheet is essentially the connecting link. So after we prepare all of these financial statements, we also want to be able to, understand the information. It's not just looking at the numbers. We also want to understand the impact of these numbers. So the basic financial statements that were illustrated in this chapter, they're useful to bankers, creditors, stockholders, and others in analyzing and interpreting the financial performance and the condition of a company. So there's various tools and techniques that are used to help analyze and interpret the company's performance. So here we determine what is the company's ability to pay its creditors, right? So if I'm someone who's going to invest in a company, I want to be able to assess these things before I decide to invest my money or lend this money to a company. So there's a key relationship between liabilities and stockholders' equity. And it can be expressed as a ratio of liabilities to stockholders' equity as follows. So we would divide total liabilities by total stockholders' equity. So in order to illustrate, we have this example here from the balance sheets of Twitter and from the balance sheets of Alphabet. So we look at Twitter and we see the end of year one, we have the liabilities and the stockholders' equity. And then at the end of year two, we have the total liabilities and total stockholders' equity. So in order for us to determine what the amounts are, the ratio, then we can essentially divide each. We would do the same for Alphabet as well. We would divide the total liabilities by the stockholders' equity. And the reason why this is important is because let's just say in the event that a business has to dissolve, the rights of the creditors, those that the company is liable to, their rights to the business assets come before the rights of the stockholders, the owners. So therefore, The lower the ratio of liabilities to stockholders' equity, the better able the company is to withstand any poor business conditions, and they can pay their obligations to creditors. So here we see in this example, Twitter, and we see Alphabet. So for Twitter, the ratio is 47, and for the end of year 2 is 49%. We compare to Alphabet, it's 29% and 31%. So as we can see, Alphabet is a profitable company that requires very little debt. So their ratio of liabilities to stockholders' equity was 29% at the end of year 1 and 31% at the end of year 2, right? And it's less than 1. So therefore, this is protected to creditors. If I'm going to lend money to a business, I would probably choose Alphabet, right? If we compare it to Twitter, on the other hand, there's more of a risk if one was to invest in creditor or invest in Twitter rather. So therefore, I just want you guys to understand that there's some key things that these numbers can give external users insight into. So it's not just numbers. As mentioned, accounting is the language of business. So this brings us to the summary. So we should have learned how to describe the nature of business and the role of accounting and ethics in business, describe generally accepted accounting principles, including the underlying assumptions and principles, state the accounting equation and define each element of the equation: assets equals liabilities plus stockholders' equity, to be able to describe and illustrate how business transactions can be recorded in terms of the resulting change in the elements of the accounting equation, to be able to describe the financial statements of a corporation and explain how they interrelate. And lastly, should have learned to describe and illustrate the use of the ratio of liabilities to stockholders' equity in evaluating a company's financial condition.